Good evening, everybody. This is going to be relatively short tonight. I was just telling Jim that when I dropped Sandy's daughter and family off at the airport this morning, on the way back, the local news said that Pennsylvania's got an inordinately high number of people with the flu. And I'm thinking, that's not going to bother me. I haven't even been out of the house for the last 4 days. Got back to the house, sat in front of the computer, and felt like I'd been hit by a Mack truck. My body just ached all over. So, fortunately, I got a good nap on the couch. That may have helped a little bit. All right, here's one of the factors that can greatly improve your analysis. If we know that candlestick signals are the graphic depiction of human nature, the T-line is a very powerful indicator. And the reason for that is the T-line and the candlestick signals are based upon human nature. The T-line is actually the 8 exponential moving average. Let me make sure. Yep, I got it here. So here is the most powerful aspect of candlestick signals and the T-line. The T-line is the 8 exponential moving average. Very, very few, and I would say statistically nobody, has the T-line on their charts. Everybody has the 200-day simple moving average, the 50-day simple moving average. In this case, we had the 20. Now I got the 34. But those are the moving averages that everybody from around the world, any major money managers, using those moving averages to make their decisions about their portfolio. But here is something, the T-line, the 8 exponential moving average. Nobody has this on their chart. Now, moving averages act like magnets. Why is that? That's because everybody that is buying big positions or making a decision about buying decisions are using the moving averages as their support because they're looking to see what everybody else is doing at a support level. It becomes a much safer trade for them. Now, I say it becomes a much safer trade if your XYZ hedge fund and you're going out and buying $17 million worth of IBM. You want to make sure you're doing it right at the right time as a analyst slash trader for that hedge fund. So it's hard to argue, or I'm going to say, you've got much more argument that you bought when you saw it was supporting. Now, it's supporting at a major support level. So the reason that prices act, or the moving averages act like magnets, is because everybody's watching to see what's happening there. So if they're selling off, what's everybody watching? They're waiting to see what will happen once it gets back to the moving averages. Now, the T-line works very effectively. And you got to remember, this is why I always say, watch to see what it's doing at the T-line. Because nobody has the T-line on their charts. So when it's acting very effectively at the T-line, it's not because everybody's waiting for it to come back to the T-line, because nobody has the T-line on their chart. It acts like a Fibonacci type signal, or a Fibonacci characteristic. It acts like a natural support and resistance level of human nature. So here's the one statement you always should keep in the back of your mind. If you see a candlestick buy signal and a close above the T-line, you can stay long until you see a candlestick sell signal and a close back below the T-line. The reason for that is if the candlestick signals are the graphic depiction of human nature, and the T-line acts like a natural support and resistance level of human nature, when you combine those two, now you've got an extremely powerful combination of keeping you in trades where you might get a little bit leery that there might be sell signals, but until you have that combination, you stay long. You can trade it on any time frame. The Dow 10-minute chart if you're trading the YMs. Remember, candlestick analysis is merely the graphic depiction of everybody buying and selling during a specific time frame. That means that if you're a day trader, you might use a combination of a 1, 5, 10-minute chart combination. If you're a longer-term day trader, you might use a 10-minute, 30-minute combination. Now, there's nothing set in stone as far as these combinations. That's up to each individual trader to decide, all right, if I know the probabilities are that if I see a candlestick signal, whether it's on a 5-minute chart or a 15-minute chart, whatever I'm trading, and I can combine that with the T-line, now my intraday trading becomes much more accurate because of the same simple statement that the candlestick signals are the graphic depiction of everybody buying and selling during a specific time frame. So it makes it very simple. We've got a lot of patterns that we can identify. For example, a big breakout. And we know we've got a 45 degree until we get a candlestick sell signal and a close back below the T-line. It makes for very simple trend analysis. And like many other truisms that we can find based upon human nature in candlestick analysis, there's one truism about the T-line. And that is, the further away you move from the T-line, the higher the probability it's going to come back and test it. So this makes your relevancy of a potential reversal signal that much more poignant, if that's the right word. You're in the overbought area, and you're starting to see indecisive doji-type days that far from the T-line. What do we know about our simple doji rule? The price is usually going to move in the direction of how they open after a doji. So we're sitting up here thinking, all right, maybe it's going higher, but we're in an overbought situation and that far away from the T-line. I'm already prepared. But if it opens lower the next day, I'm closing the position immediately. Why? Because the Japanese rice traders have told us for 400 years that if you see a doji in the overbought area, get ready to take profits. Char, are you sure you're clicked on screen sharing up at the very top of your page? I hope it's live. I feel dead, but live. And there's always this situation. When you gap way down and you start seeing buy signals, what's the first thing you want to do? See what it does at the T-line. If it goes to the T-line, tells us we're looking for our next targets. If it fails at the T-line, and you bought down here, you close out the position and wait for it to close above the T-line. If we can see exactly what's going on in human nature, notice how they've closed it below, closed it above, closed it below, closed it above. What does that tell you? That pretty much tells you there's no trend here. Move on to something else that have something more like this that you can easily identify. I love the solicitation calls. When I pick them up and I hear them go boink, I know to hang up immediately. All right, so anytime we're looking at something, In candlestick analysis, what is the most important analytical factor? The candlestick signal and or the pattern. That's the whole purpose of candlestick analysis. Then we can start adding other indicators like our best friend signal, our T-line acting as support for a fry pan bottom, T-line acting as a support for fry pan bottom. We can start analyzing with much more clarity that if there's a lot of indecision sitting right here on the T-line, and we can start seeing this projection, we know what to expect. We expect that to break out. So knowing what each signal represents, lots of indecision, and it's doing it on the T-line, gives us that much more expectation to watch for a breakout situation. Billy, this could be a 1 minute or 5 minute chart. It doesn't matter what the time frame is. This could be a 1 minute chart. This could be a 10-minute chart. This could be a 30-minute chart. It all depends on what you're trading. They look exactly the same. So why does a T-line entry confirmation add to your ability? Should you be buying above the T-line or below it? John, we will get to that. I'll see if I can find, let's see if I can find something. Remember what we said in the beginning, the further away you move from the T-line, the higher the probability these aren't good charts to. I'll show one as where you buy if you're below the, what about during extreme volatility? Remember, it doesn't matter what time frame it is. You go to the chart before. This one? Okay. So what is the question? What about during extreme volatility? Well, again, what does coming up through the T-line, closing back below the T-line, coming up through the T-line, closing back below the T-line, what's that illustrating? That's pretty much illustrating there's no force to break you out. So if I was buying right here based upon expecting a J-hook pattern, where am I selling? Right here, because I've got a left-right combo closing back below the T-line. The best friend, there's about 18 different combination patterns. The best friend is a doji followed by a gap up, especially in the oversold area. The reason we call it your best friend is because not only does it give you a high probability of an uptrend, probably that uptrend is going to be extremely strong. Oh, John, which chart was that on? November 7? Yes, if you see, remember, what is this type of signal in the oversold area? That's our belt hold signal. So what happens at a belt hold signal? Where do most people sell? They panic sell at the bottom. A rhetorical question that most people ask is, where do you grab for the fallen knife? That's made a lot easier when you're using candlestick signals because based upon the open and the close tells you what's happening. What does screen share look like? Gary, you should be seeing the screen right now, the charts. If you're not seeing the charts, up at the very top of your page, the very top line, the furthest left little block is slides. The next one to the right is screen sharing. That should show you the charts. Okay. So if I'm short, where do I start looking for a reversal? Again, the simple rule the Japanese rice traders tell us quite often is where do most people sell? They panic sell at the bottom. If you see a gap down in the oversold area, you start watching for a reversal. Just see the title only. Oh. On the next line down, Gary, you should have there should be a box where the arrows are all pointing in, another box where the arrows are pointing out. Click on one of those and see if you can't get a full screen. Or slide the bottom of your page down so that you're making the chart area much bigger. Okay. Again, as we're going to go through this, we're going to have a new mantra this year. And that is, we're not going to just teach you how to learn how to use candlesticks. We're going to make you learn how to use candlesticks. I'm going to keep illustrating things that are just very simple common sense, such as where do most people sell? When you see a gap down in the oversold area, start watching for a buy signal. When you see a gap up in the overbought condition, start looking for a sell signal. Okay, so here's what we're trying to do. I saw in one chat room, maybe it was even our chat room within the last day or so, somebody saying, well, it's hard to, if you can get a 50-50 win ratio, you're doing quite well. What we're trying to do is put the advantage in our favor based upon what happens in human nature. So if I kind of assume, or with an unofficial tally, I would guess that probably 2 out of 3 of my trades are going to be positive, or approximately 70%. Now, before, that sounded like heaven to me, but as I kept going, I realized that even if you hit a 70% ratio, which is extremely good, you also have to realize that 30% of your trades aren't going to work. So you need to know what your signals look like and when a signal is not working, you come right back out of it. Raymond, the chat room during the day is open all day. People start coming in about a half an hour, 45 minutes before the market opens, and we go right through till after 4 o'clock. So here's what we're trying to do. If 70% of our trades are positive trades, now that doesn't necessarily mean they're 200% positive. Some might be 0.3% positive. Some might be 12%. But more than likely, you're going to be in a positive trade. That also means 30% of your trades are going to be losing trades. Now, what we try to do based upon using confirming indicators like the T-line is try to drop down to 29.1% losing trades, or 28.7, or 27.9. They may not seem like big moves, but if you keep doing this in your consistent trading, that little factor multiplies your positive trading dramatically. I puts all day, and you can't go wrong. That's right. So the question is a candlestick signal and a close above the T-line. That is your ultimate. Now you can look at different situations. What if it closes at the T-line? Or what if it closes below the T-line but it's coming up? Or it comes up through the T-line? If I see a doji gap up through the T-line, that tells me that's my best friend. The T-line's not going to act as resistance anymore. if I see a doji gap up through the T-line and through a resistance level. Tells me I'm putting myself in a situation. I don't know what that is. I got some spam that just pops into the corner here. So makes it very simple. A doji best friend gap up through a resistance level off the 50-day moving average through the T-line puts me in a situation where the probabilities of being in a strong trade are greatly in my favor. 4X this morning, Apple gap down. Yes, but we knew Apple was going to gap down ever since their announcement. SP, where have you been? That's the whole point of this session. The T-line is the 8 exponential moving average. So how do we use the T-line for stop loss? Again, if we see a candlestick buy signal, we can stay long until we see a candlestick sell signal and a close below the T-line. So if we're up here as a doji and they gap it down through the T-line, what's the first thing we want to do? Close out the position immediately and go on to another trade. If we're taking profits, uptrend, 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 we see a potential sell signal to close below the T-line, you close it out right away. Because what's our simple rule of the doji? It's going to move in the direction of how they open after a doji. Bullish above, bearish below, yes. So if you see a candlestick reversal signal and a close below the T-line, just remember this one statement. The probabilities are that you're heading down until you see a candlestick buy signal and a close above the T-line. So if I'm looking at something like this, well, I can see where the resistance level is. Now I've had a little left-right combo coming back up through the T-line. If it trades positive, what's it telling me? They're breaking out through this little resistance level. And the next day they didn't open it positive. What do I need to see the next day? I need to see it open positive and trade positive. The fact that they opened it lower and closed below the T-line told me this was not a trade that's breaking out. The probabilities are it's still heading lower. That is the most informational piece of information about the T-line. The probabilities are that if it closes below the T-line, you probably have better probabilities you're in a downtrend. If you see a candlestick buy signal and a close above the T-line, the probabilities are pretty strong you're in an uptrend until you see a candlestick sell signal and a close below the T-line. When you say candlestick, close below the T-line, are you referring to the time period or the close for the day? Again, Bill, that's up to you, whatever you're trading. If this was a 5-minute chart and I was ready to buy on this breakout, it doesn't matter. This chart would look exactly like an hourly chart or a weekly chart or a monthly chart. Candlestick charts are what they call fractal, which means they look exactly the same, use the same indicators on any time frame. So the whole point of this illustration is that the probabilities are extremely strong that if you see candlestick buy signals, you can stay long until you see a close below the T-line, and or you start moving too far away from the T-line in the overbought area, you take profits. You can always buy back if you got a J-hook pattern setting up. What did I just? Okay. So T-line analysis is very simple. Let's say the bobble or the T-line crunch. The bobble, very simple. Comes up, hits a resistance level, and then notice where it pulls back. They couldn't close this below the T-line. Now, just so that you hear the reiteration. The reiteration is, when they've kept this above the T-line, remember, nobody has the T-line on their charts except very few people. So when it's bouncing up off of this T-line, it's not bouncing off a T-line on everybody's chart, on our charts, but it's just, it's holding up at a level that we know is telling us that if we've taken profits here, we can start buying back here because now we've got a bobble breakout in progress. The fact that when they hit the resistance level and they can't close below the T-line, even if you took profits in here, you can be buying here because that was good confirmation that the sellers could not take control. So if I'm looking for a bobble breakout and I close it here, what am I looking for down here? For it to bounce off the T-line and coming back up through the 50. When it closes below this level, what's it tell me about my bobble? It's not there. Left-right combo comes up and fails at the 50. Now what's this one telling us? They can't close it below the T-line. Get ready to buy on the breakout. Yeah, you could go short here on weakness. So this is just kind of an illustration that if you have a doji Harami failing right at the 50 and it opens lower the next day, what does that tell you about the 50? They're not going through. They're selling it off. Michael, yes. Now, that's not to say that if you want to use the 8 crossing the 20 or the whatever you want to use, the nice thing about candlestick analysis is we've got one basic element that works consistently, and that's the candlestick signals. Now you can start applying whatever confirming indicators you want to on the chart to confirm what the signals are telling you. So every time I see a situation where I might be taking profits, but I can identify when to get back in, it's just telling me get out when it's time to get out and get back in when it's time to get back in. And the reason for that is when it pulled back to the T-line and did indecisive trading and started back up, the probabilities told us they weren't closing below the T-line. They were still heading higher on the next J-hook wave. So if this is wave 1, this is wave 2. Wave 3 is going to be the same magnitude as wave 1. Let's see, we did that one. So here's what I'm looking for. Comes up, pulls back. What do I want to see to buy this one again? I want to see it break out. The fact that it opened lower and traded lower told us you got out here at the failure. You're not back in yet. On the other hand, if you come up here and you fail, notice how it kind of hugged the T-line. You can be buying back here because that's telling you they couldn't pull back. Now the next wave is in progress. A left-right combo. I'll see if I can find one. A left-right combo is basically a doji followed by a bullish engulfing signal, or at the top, a doji followed by a bearish engulfing signal. And this is what we call the T-line crunch. Oops, did I do this bobble? Notice how they failed up here, and there's your shooting star. You close it out on weakness the next day, but then notice what's happening. They can't close it below the T-line. Where do you buy back? Buy back in here, because that tells you the next wave is starting. If I'm buying right here, there's our doji sandwich through the 50. What's it tell us about this level up here? The T-line, this is called a T-line crunch. Notice how the uptrend continues right through the resistance level with the T-line pushing everything up through that level. Still looking for a... So it doesn't matter whether you're long-term investor, swing trader, day trading. I trade different commodities during the day using the 10-minute chart. There's our gap down below the T-line. Now look where we are down here in the oversold area. Start to see buying What's our other little relevant factor? Look how far away we've moved from the T-line. More than likely, they're going to come back up and test it, so we're taking profits down here. Let's see. So the little green line is the 3T line, which becomes more effective the further away you move from the T-line. I've got them on some. There's kind of our 10-minute fry pan bottom breakout. And when was it time to take profits? Doji, shooting star, good distance away from the T-line. So if we were buying right here, we're taking profits right in here because of the distance above the T-line, and we're starting to see sell signals. So the T-line helps us with pattern confirmation. Uptrend, profit taking, a pullback, then look what happens when it hits the T-line. There's your best friend gap up. So what's that telling us? Wave 1, wave 2, wave 3 of a J-hook pattern. Breakout, pullback. Wave 3 is going to be the same magnitude as wave 1. What was compelling about this? This is your left-right. This is your left-right combo, a doji followed by a bullish engulfing signal. We're going to be probably doing another high profit pattern session here in the next few weeks. And the first thing everybody should be doing is learning the signals themselves. That's your bread and butter. Then we can start amplifying that or enhancing it by seeing what signals don't occur and what type of patterns are setting up. So crude oil bounced up. Notice that it failed the T-line, a bearish engulfing signal. Where do you think the next price target would be on this chart? If this is wave 1, wave 3 is down here somewhere. And the reason we would think that it's failing up here, what is this signal right here? That is basically telling you this is not a reversal signal. So if we don't have a reversal signal, what would the Japanese rice traders, if this was significant, what would the Japanese rice traders have illustrated for us over the past 400 years? What the significance of this signal would be. But since it's not significant, there's no signal identification, which now gives you the prospect that they could probably bounce it. So if you were short, you cover your short, and then you just watch, because this isn't a strong reversal, see what happens once it gets to the T-line. You could probably re-short it. So these are just simple little, a signal. Remember, we're looking at the 12 major signals. Out of the 50 or 60 candlestick signals in the candlestick universe, they were identified by the Japanese rice traders over 400 years. And they use one very simple indicator that they use, and that's human nature. Human nature has not stopped working the same way time after time for the past 400 years, and it won't for the next 400 years. All we're doing is identifying what normally happens in human nature. Yeah, so they may, and again, notice how far away you moved from the T-line. So that's probably going to be a little bit of a bounce here. So when we can do trend analysis refinement, for example, like the steady eddy is one that if we start identifying that the steady eddy continues to move and stays above the T-line, if we're using my simple money management system that I might have 10 equal dollar amount positions on, if I've got 3 of them that are steady eddies, it only takes 4 seconds to analyze what to do when I bring up this chart. And that's very simple. I just stay long until I see a sell signal and close below the T-line. Uh, Bill, yes. And that's one thing that we're going to be doing here pretty soon for a members night is just going through the common sense of where you put your stops. And that all comes into the process of over the 40 years plus. I can't imagine I've been trading for 40 years plus. I have. That I've heard tons of money managers say, cut your losses short and let your profits run. But I've never heard a single one of them say how you cut your losses short and let your profits run. Candlestick analysis, because it is based upon common sense investment practices, you use common sense stops to tell you where you should not be in this trade anymore. So if I was long this position, and it's been moving up steadily, staying above the T line, I just put my safety stop someplace where it shouldn't be trading. Is there a way to tell if the crunch will continue or just simply watch if it falls below the T line? One of the things that you always, and this will be another thing, let me get, hold on, I see it, so I'll get to it. Again, there's your kicker signal, when to sell, when you see a sell signal and a close below the T line. When can you buy back? When you see a J-hook pattern confirming. It used to be that if I happened somehow to be lucky enough to be in a winning position and I got out, they weren't going to fool me and get me back in and then turn it right around and take some profits, more profits away from me. Yes, you can always use a trailing stop at a logical spot that tells you it shouldn't be trading in that area. So if we see something like this, where you had a bearish engulfing signal and a doji, we know what our simple doji rule is. It's going to move in the direction of how they open after a doji. If they're trading down the next day, we're out of the position. It's time to take profits. Just, again, very simple rules. So what normally happens is if you go up through a resistance level, they'll usually bring it back to see if that resistance level is going to act as support. That's just kind of a common trend ritual that occurs in an uptrend. Would you be in and out of the trade? Yeah, there'll be times where I'll close out the trade because I don't know whether it's going to pull back here or here. But when I see that left-right combo, remember our left-right combo is a doji followed by a bullish engulfing signal. The left-right combo is one of your most powerful reversal signals. A lot of times you can be in and out of the position without the next day confirmation. But in this case, if I saw a left-right combo bouncing off the 50, notice that we're in the overbought condition. So the very simple rule is if we're looking for a candlestick buy signal, we're looking for it to occur in the oversold area. If we're looking at a candlestick pattern, it usually occurs when the stochastics are already in the overbought area. Yeah, the volume, a lot of people ask, a lot of people say, oh, I want to see the volume go up as the price goes up. Volume and price have absolutely nothing to do with each other. If the stock is doing well and nobody wants to sell, it's going to keep going up on low volume. Now, when it does become relevant, let's say you saw a doji down here in the oversold area and it had a big, huge volume spike. What can we assume from that? That there's been a big change of ownership. That's usually the smart money buying from the panic sellers. That's true, Salam. Yes, it had a bullish engulfing signal. But remember, we were still very tentative. It finally closed up positive going into the close, and it came back up above the T line. So what did we need to see today to tell us the bulls were still in control? Obviously, bullish confirmation. The fact that Apple came out and projected their sales and earnings lower, that was a perfect example of the fact that prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. So Apple gets whacked today, and what did the rest of the market do? Fell off. Now, you know that 99.99% of all the other stocks had nothing to do with what Apple earnings were going to be or their projections. But investor sentiment turned south, and everybody sold off. Bill, I've been stopped out many times. So if this opened right here after trading below and I closed out, I don't have any qualms about when it starts turning positive and coming back up, buying back. So if I sold out here and bought back here, all right, maybe I missed out on 80 cents. But I wasn't buying this position for 80 cents. I was buying this position for hopefully another $4 move to the upside. So that 80 cents was just a insurance that I wasn't holding on to something that was ready to move all the way back down here. Lee, I will get to that here in a second. There's your kicker signal. There's your support at the 50. There's your T-line crunch. How long do you own this one? As long as it stays above the T-line. Except what's your little warning on this chart? Look how far away you're starting to move from the T-line. You start watching for taking profits. So the T-line trend analysis is very simple. You're in a market where it's consistently above the T-line, you stay long until you see that reversal. Notice what happened here. This is today's chart. What is this signal right here? Look how far away they moved from the T-line. What's that signal right there? None. Very good. So if this is not a reversal signal, what should be your first suspicion? That you might bounce, but you don't have probably a reversal signal. So if they start selling this off again tomorrow, what does the T-line tell us? Yeah, it was just a bounce to the T-line. Now if they start selling it off, what potential pattern do we have setting up? This is why you want to know your patterns, and this is why we're going to concentrate on everybody knowing the patterns in general, but making sure each one of you learn 3 or 4 to the point where you become an expert at that signal, knowing what you should do to confirm, what you should do to be back out of that trade, what you should do to stay in that trade, so that you're not guessing, that you're analyzing what happens in normal investor sentiment. Eric, isn't it a 3-candle morning star? This one? No. Remember, a morning star signal, there's an evening star signal. A day of indecision, there's an evening star signal. Big up day, a day of indecision. This wasn't really a day of indecision. However, what was the warning that they might bounce this the next day? Where do most people sell? They panic sell at the bottom. When you see something gap down in the oversold area, get ready to start taking profits and or start going long. So if this was not a reversal signal, what do we watch when it gets up here? Let's see whether they can get through the T-line. If they start selling off, you got a wave 1, wave 2, wave 3. Now, is that bad for investing? Definitely not. If you know that the market is selling off, you can very simply scan for the signals and patterns that are ready to go short or that you want to short, knowing that if you can analyze the direction of the market and find positions that are selling in that down market, again, you're putting all the stars in alignment. Here's the NASDAQ. Same scenario. What was this reversal signal? It wasn't. They tried to bring it back up, which would have been good. It would have told us if this opened positive today, where was our next likely target? They're probably coming up to the 50. The fact that they gapped it down, notice where they gapped this down to. Right at the T-line and went the opposite direction. So what pattern can we see here? Bearish J-hook. Now, if it doesn't open lower tomorrow, and let's say does a doji type day, and then starts trading back up Monday, what's the pattern we might start watching for then? Seeing if we've got a bullish J-hook pattern setting up. So right now, we don't know which way they're going on this market. Tomorrow we'll add more information based upon how they open it and the direction they trade it. So right now, the assumption has to be we're still in a downtrend because they're still trading below the T-line. That very simple assumption allows me or any investor to say, all right, I'm going to scan for shorts tonight. And if I see a good short, maybe a bearish doji sandwich, but if it opens lower, I want to be shorting it immediately. So I had long positions on today. Netflix was up 4 points. And what was the criteria that kept me in this one today? Still trading above the T-line. However, I was also long Roku. But notice what Roku did. Did a bearish harami and a close below the T-line. In the old days, I would have thought, oh man, this was in an uptrend. Maybe this is just one bad day. And now open it positive tomorrow and take it back up. That's because that analysis is now because of the great H, the great hope that that's what would happen versus bearish harami and a close below the T-line. Even if this started trading up a little bit, what's happened to our trajectory? Kind of fizzled out a little bit. I'd rather go find something where the probabilities are much greater in my favor. What do you do when the market is not showing you any great resiliency? You don't know which way it's going. The benefit we have is that we can analyze commodities, currencies, anything. Yeah, we can sit it out, or gold prices continue to move higher. Take a gander here and see if they've moved higher yet. And it's up 43 cents or $4.20. So it's still trading higher. What's this tell me? I've got a T-line crunch. And where are we trading? We're still trading above the T-line. So what sector do you think is a good one to be looking at? We've got KL still working nicely. We recommended SA. What's this big pattern right here? Fry pan bottom. And what is our fry pan bottom rule? Very simple. If you see a fry pan bottom, what's this telling you right here? Investor sentiment is building back up. It's not doing it in a quick fashion. It's building back up. So you've got a very simple fry pan bottom rule. You stay long until you see a sell signal and a close below the T-line. So the nice thing about candlestick analysis is that you can use very simple rules to put yourself in situations where the probabilities are greatly in your favor. The most simple T-line rule is if you see a candlestick buy signal and a close above the T-line, the probabilities are you're going to be heading positive. All right, that's about all I've got tonight. And I will be the first one to confess to the fact that I was a stockbroker for 8 years, and I was probably the worst investor in the world. But fortunately, I did everything that a normal investor would do. So when candlesticks came along, I could start seeing the opposite. This was usually me selling down here because I couldn't stand the pain anymore. This was usually me. I was buying up here and selling here. And it always seemed to be that when I called up my clients today, we better get out of this one. That 2 weeks later, it was way back up, and I had to keep asking myself, what the heck is wrong with me? Why am I selling down here and it turns around right away? Once I realized I was buying and selling at the wrong end of the spectrum, I would tell myself, all right, if I'm in the oversold area and I start seeing buy signals, let's go after it. Let's be a buyer. When I started doing that, instead of being a consistent contributor to the market, I became a consistent extractor from the market. Sophie, this is the stochastics, which is a common indicator, and it's set at 1233. GB, I think it is still available. Is that the 3 books? It might be off. Abe is out of town. He'll be back Monday. If you just email Abraham at candlestickforum.com, just say I'd like the book special. Steve said I could get it. He'll get it to you. Oh, you want to know about the penguin? You want to mention the recording? Yeah, the recording won't be posted until Monday because Abe is at a place where he can't get internet. Okay, the penguin joke is when there's a. I illustrate this by when you tell people what to do without them understanding why they should be buying, it doesn't do them any good. And that we illustrate by the candlestick signal was a doji bullish left-right combo. So a cop standing on a street corner, and here comes this drunk weaving down the street in his car. He blows his whistle, pulls the drunk over, walks up to his window, and looks in the back seat, and there's a penguin sitting there. He goes, what the heck are you doing with a penguin in your back seat? Drunk said, oh, I found him out on the street, and I don't know what to do with him. The cop said, well, take him to the zoo. Drunk said, oh, that's a good idea. I didn't think of that. Next day, the cop's standing there on the street corner. Drunk comes weaving down the street. Cop blows his whistle, pulls this guy over, looks in the back seat, and there's a penguin still sitting there. He said, I thought I told you to take the penguin to the zoo. Drunk said, I did. He liked it so much today we're going to a baseball game. So if you don't understand why you're doing something, it doesn't do you any good. John, the December special is I've written 3 books. The first book was published by Wiley & Sons. It tells you about all the candlestick signals and kind of the concept. The second book is more meaty, high profit candlestick patterns. It goes more in depth on the 12 major signals and the different patterns that you can utilize. Then the third book is one that after you've learned your signals and patterns, there's still one big bugaboo that most of us have, and that's our own emotions. So the third book was written on how you use the candlestick signals to kind of eliminate your emotions out of your trading. Okay, so with that, how do I buy? Right now, I think we got a link somewhere. One of my the grandkids are here. Pittsburgh, down at the Heinz Museum, had the space exhibit with the some of the space capsules. So they really got a kick out of that. But I discovered when they asked one of the astronauts what did they think about the first diner on the moon, he said, "Oh, the food was good, but there's not much atmosphere." For day trade, do you use the same? Yes. This could be a 5-minute chart, a 10-minute chart, a 1-minute chart. It all looks the same. So if I am day trading and I see this occurring or see this occurring, knowing that the daily chart is trading positive, then I'll flip to my 10-minute chart and see if I can day trade it on the 10-minute chart. I don't know. Let me try this. All right, here is Apple. So there was your morning star signal with your inverted hammer. What did we need for confirmation? Bullish trading above the T-line. It never happened. Now, they've gapped this one down. Could probably still be in a downtrend. But remember, where do most people sell? They panic sell at the bottom. So I would start watching. If I was short, I'd start watching for any buying that was down here. What was the circled? Just this area. Doji. Remember, if you see dojis in the oversold area, what's the dojis represent? Indecision. You want to see if there's a new decision being made. But stochastics, yes, stochastics rolled over. So you're in the overbought area. I would suspect there's still going to be some more weakness. I got this all on here. I expect some more weakness, but the fact that they gapped this down, remember, this probably wasn't a surprise. If we're sitting out here in the hinterlands with no research, think of all the institutions that have, oops, I'm going way up here. So the assumption has to be, if you were an analyst, you probably knew from way up here that things weren't great. This isn't selling off because this is surprise news. This was selling off because the people that were following Apple and analyzing what was going on were probably selling off their positions. The black line on here is the T line. This line is probably now the 34 EMA. Works a little bit more effectively than the 20. Yes, and where do most people sell? They panic sell at the bottom. So you start seeing buy signals, you got to start asking yourself, who's buying down here? And usually it's the smart money. All right, everybody. We're probably still in for a soggy market. And if we start seeing, I don't even know where the pre-market futures are right now. Oops, they're up 10. So that might be that that you might have a J-hook pattern setting up, but tomorrow will be indicative of whether they're starting for wave 3 to the downside or whether they're trying to set up for a J-hook pattern. All right, everybody. We will see you bright and early in the chat room tomorrow. We'll see you then.